Alright, so today we're going to talk about a strategy called dollar cost averaging. Now, this strategy has been used by a lot of average investors to become millionaires over the years. And why is that? It's because they've been buying into the market as the market moves up or as the market moves down. Consistently, they put money in every month, and that way you buy actually shares of companies every month. So you don't lose out when the market does go up or when the market goes down. As you can see from this diagram, as the prices go up, a lot of people ride the wave and feel happy. So they buy more shares as it goes up. And then when they reach a euphoria point, that's when they buy the most. And when the prices drop, that's when they start feeling like they're losing out. So many investors often sell at the lows and buy at the highs. This is what we call the emotional roller coaster. You should always try to avoid timing the market because it never works when you time the market. And it also leads to poor results. So what we do, we use what we call dollar cost average strategy, using a system where you buy systematically even when the market is down or when the market is up. This way, you will be purchasing shares on a regular basis regardless of the market direction. So you remove the chance of making short-term emotional decisions. So dollar cost averaging is a strategy that can help you lower the amount you pay for investments and minimize risks. Instead of purchasing shares at a single price point with dollar cost averaging, you buy in smaller amounts at regular intervals, regardless of price. So over the long term, dollar cost averaging can help lower your investment costs and boost your returns. Even one of the greatest investors, Warren Buffett, has always been a proponent of dollar cost averaging for the regular folks. That if you like spending 6 to 8 hours per week working on investments, then do it. But if you don't, then dollar cost average into an index fund is the best bet.
A broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time because the very nature of index funds is that you are saying, I think America's business is going to do well over, or reasonably well over a long period of time, but I don't know enough to pick the winners and I don't know enough to pick the winning times. Important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time.
Now, a little later on, I'm going to talk about another strategy that you can combine with dollar cost averaging, which will even juice up your return when it's favorable to your portfolio. Now, many people are tempted to time the market by buying low and selling high. Now, in theory, it sounds really great, but in reality, it's impossible because there's no way anyone knows when the market's going to bottom or when the market peaks. So it's all guesswork. Among all the gurus that you hear, they all are just guessing or giving their best educated guess. So timing the market does not work. Do not try it. I mean, I've done it in the past. I've lost a lot of money, so I'm just giving you a warning not to do it. And as I mentioned before, there is a way to juice up your return even more with dollar cost averaging. And that way is to buy more when the market is falling. Now, I know that's scary, but if you did that, you will actually lower your dollar cost averaging even lower so that when the market does turn, you will reap a lot more gains. So if you want to become a millionaire in the long term, it's not that hard. Many of us, average people, can have $500,000 to $1 million by the time you retire. You just have to remember two things. One is to invest consistently into the market and not look at it. That's the best way. And two is when the market is falling and you're aware that the market is falling, is to buy even more. So you will invest, instead of, let's say, you will be investing $100 a month, you might want to juice it up to $150, $175 if you can. So that way you will get more of the cheap prices of the stock. And when it does rebound, you will be all set. And dollar cost averaging do work because I have many friends who have no clue about the stock market, but all they've done is do a consistent investment into the market on a bi-weekly or monthly basis. And after 10, 20 years, they are now millionaires. And they didn't really do anything besides doing the dollar cost average strategy. So if you believe that you have some time and you're not looking for a quick buck, this is the surest way for you to become a millionaire. Now, why does dollar cost averaging work as opposed to market timing? Well, very simply, dollar cost averaging works because over the long term, asset prices in the market tend to rise. But asset prices do not rise consistently over the near term. So instead, they run into short-term highs, short-term lows that may not follow any pattern. And when I say invest in the stock market, I really mean investing in an index fund or ETF that tracks either the S&P 500, or if you're willing to accept more volatility, a fund that tracks the NASDAQ. There are many companies such as Schwab, Vanguard, Fidelity that offers funds that tracks both indexes, and they have really low management fees. And this is important. Make sure the index ETFs that you invest in have low cost management fees, because these fees can really eat into your returns later on. All right, so I hope you enjoyed this video, and I hope you will implement this dollar cost strategy into your portfolio. Now remember, it will take some time to see the rewards and the gains. So please do keep it up, be consistent, and invest for the future. And if you like my video, please do comment below, click the like button, and please subscribe. And I hope to see you on the next video.